Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, streaming live in YouTube. We have a pretty exciting day today, depending on what position you have, whether you are short or long, whether you're looking for the price to go up or the price to go down. The FOMC meets today, and Chairman Powell is going to give us an idea of whether we're going to be tapering or not tapering, or interest rates are going up or going down, which seems to be the fundamental dilemma that is pretty much capturing the markets, creating a tremendous amount of volatility. So my guess is that markets may be initially bearish if there is some kind of tapering talk. Let me clarify my position here. I believe that the Feds cannot raise interest rates. We are at a pivotal point in terms of the credit markets, and raising interest rates at the same time that we have a debt ceiling deadline, it just doesn't make any sense. So we got to just listen to the language carefully and see what they are trying to say or not say in reading between the words. So markets are pretty volatile based on just the anticipation of interest rates. It's amazing how these markets are, at the basically at the control of the Feds or central bankers with regards to interest rates. One of the things that I want to point out, which I think is pretty obvious, hopefully pretty obvious to most people right now, is the fact that the 10-year note has been trading roughly about 130. And we're looking at the CPI coming out, indicating that we're running at about 5.3% inflation rate. So deduct 5.3 minus 1.3, we're under 4% in terms of purchasing power based on current inflation. And my estimation is that this is the beginning. We're still getting a lot of supplies, short supplies squeeze. It's affecting price inflation in addition to monetary inflation, which is really what the Feds are doing by providing all this tremendous amount of stimulus into the economy. It's not positive for the U.S. dollar. The more money they print, the more the U.S. dollar loses its integrity, its purchasing power as a world's reserve currency. And it puts in jeopardy the demand in U.S. dollars by some of our foreign competitors. The U.S., since Nixon lifted the ban, you might say, on the gold standard, away from the U.S. dollar, the United States has been exporting inflation to the rest of the world. And I think after 40 years or so of the U.S. dollar being the U.S. world's reserve currency, the economics that we're dealing with right now do not support, in fact, for the U.S. dollar to continue to be the U.S. world's reserve currency, particularly when it's becoming, where it is, the largest U.S. debtor. So interest rates cannot go up. Now, whether they manipulate the yield curve and create an inverted yield curve which means that the short end of interest rates will go up while they put a cap on the 30-year bond. It's possible. They have been trying to manipulate and have been manipulating LIBOR rates, interest rates in the U.S., and we're dealing with a situation that is very similar to the 70s in terms of inflation. The difference is that we didn't have the amount of debt then that we have now. And so there are different fundamentals that I believe are making it very, very difficult to continue to have this just unrelented debt levels going, skyrocketing, and monetizing the debt simply to pay the interest. We're dealing with a fragile economy, and things have not yet been clarified, so to speak, in terms of the actual, financial damage that we have experienced during this pandemic. We're still dealing with the, variant, the possibility that people are getting very nervous going back to work, and some certain jobs, such as childcare, have become very difficult to find people. People at the service level, blue-collar workers, they've been getting a free ride, so to speak. So why work? Why bother work when the government is pretty much supporting you? And, that kind of goes into the argument of universal income in that sense. And so that's a whole different issue that, has been discussed, and whether it's possibly the best thing to do, for the world is to go into some kind of universal income, and so it's really kind of out there ideas that I don't think are realistic enough in using the basic elements of economics in terms of what makes a strong currency, what makes a strong economy. And a fiat currency that is not supported by anything except the trust and faith of a government that has increased its debt to GDP by 32% is really questionable. And I don't see anything that indicates that. Unless we get a surprise today by Chairman Powell, and he decides that it's time to begin tapering, and cutting down maybe some of the purchases they do monthly from 120, maybe 10 a month, whatever, over a period of time, and maybe establishing the beginning of this tapering process, which has to occur. But the question is whether the time basically is correct or appropriate or timely to do that right now, particularly when we're getting a lot of black swans coming out of China with Evergrande, the second largest real estate holder, is potentially going to default on about $300 billion worth of which I believe now it's $400 billion in liabilities. As long as I've been around, if they're talking about 300, it's more like 600. So there is still a lot of things to come out of there, and the question is, how is it going to affect the world markets? Is it a systemic risk that can create contagion across the global and the global markets and cause massive sell-ups, just like we did back in 2008 during the mortgage crisis. And so could this be the beginning of the Lehman moment, as they say, where China is the catalyst, you might say, with this default, that's potentially can happen by tomorrow. Tomorrow, I believe, is the deadline. And so how is that going to affect, or is it going to affect the financial markets? I think we've seen a bit of a sell-off here on the equity markets in anticipation of that the last few sessions, but we pretty much have regained quite a bit um, of the correction. So bringing the market down to about 42.93 in that vicinity. Uh, so let me just finish my summary, so to speak, in terms of interest rates, and that I believe that interest rates are not going to go up. They can go up. It's impossible to go up. They may talk about tapering, and I think what we're going to see is more rhetoric than action, because the Feds know that they can't, at this point in time, raise interest rates. It would cause massive sell-offs across the global markets. And they don't want a collapse in the equity markets, which is what they've been monetizing basically by, all of this stimulus, all of this money coming into the market, which has been going into, obviously, equity markets, the stocks. A lot of people have had excess money that they don't need, so they've gone out and purchased assets. Rolexes have gone through the roof, acids, precious metals, not yet, but there's a lot of demand in the physical market, and so we're beginning to see at least the wave curve starting, from some of the smaller accessible assets that people can buy and eventually move up into the, I believe, more higher priced items, precious metals across the board, because inflation is not temporary. And we get in with a triple threat in terms of inflation. It's not just price inflation. It's monetary inflation, price inflation, and pretty much we're looking at the level of inflation here to be understated using the 70s formulas, just basically, which include food and energy. We're looking at an inflation rate which is really running at about 13%. During an economy with negative interest rates, we're not in the same position as the 70s, where Volcker, pretty much raised interest rates all the way up to 14, 15% by 1981. And if we were to get, you might say, the levels of interest rates just to go back up to the average, which I believe is about 4%, maybe 5% over the last 10, 15 years, it's impossible. It's impossible for that to happen. Just calculate, 1% increase in the debt, the current debt level. Now we're talking about increasing the debt ceiling. So we're moving into another politicized period of time that there's going to be a lot of rhetoric about raising the ceiling, not raising the ceiling. The fact of the matter is that they have to raise the ceiling. Otherwise, this country is going to go bankrupt. It's as simple as that. And they can't afford to do that. But there will be political rhetoric. And, maybe some of this political rhetoric is what they feel the market needs to take some of this heat off in terms of the prices, the inflation in prices. And so, I think potentially what could happen is that we go into a high level of inflation and stagflation in some areas. So we can have a really, really conflicting economy. It feels more like stagflation, where we're getting inflation in asset prices, but basically the price inflation is a consequence of the short supplies, the broken supply chain, and that's coming in, affecting it. In we're not sure whether that's going to be also prolonged. Um, Very difficult to get supplies just across the board. Um, so the reality is that we are running negative interest rates by 4% if you take into account the 10-year note, as I said. So the reality that I believe is basically that um, instead, actually, of raising interest rates, the Fed is going to come to a point where they realize that they have to bring interest rates lower, more negative. And so, you're looking at an inflation rate increasing while, you get the 10-year note trading at about 130. Even if it goes up to 2%, you're getting a negative yield, basically, accounting for inflation. And so they don't talk much about this, and the way that the Feds are trying to cover this is basically by saying that it's temporary. We're moving into a whole new system, an economic system. The old fiat system literally is collapsing in front of us. It's coming to the end of a 40-year cycle that essentially signifies a change of guard. If you just count back from 1971, Bretton Woods Agreement was made 40 years prior to that. So the question is, what will, if there is another currency stronger than the dollar, what will replace the U.S. dollar without the U.S. dollar going to war? Which, has been done in the past from countries like Libya, Gaddafi, that wanted to go into the gold standard again, was eliminated out of the system. So I think the momentum that we have as a consequence, as a consequence of course, the tremendous amount of stimulus that has come into the market already, has devalued the dollar by that much. Most of the assets that you see here in price, like real estate and, you can take a look at paintings, even virtual assets. People have paid millions of dollars for a coat, for a digital asset that has been created. Bitcoin was created on the premise that it will create and provide humanity a hedge against inflation, against some of these policies that have been implemented over the years that do not favor the common man. A lot of manipulation, corruption has taken place. And now, as I pointed out a while back here in a report that we published on the Associated Press, and you can Google this, the IMF is preparing additional funding provided, additional capital to countries that may go into trouble. They are expecting some kind of trouble unfolding in some of these third world countries as a consequence of the US dollar. So they have allocated trillions of dollars that will be provided through this new currency that's being created, as they say initially, for the benefit of central banks to exchange, called SDR. The special drawing rights, which are receipts that are going to be used as a currency for them. So, trillions of dollars are being created out of thin air, devaluing more and more world currencies, fiat world currencies. And so the argument obviously has become clear to people that believe Bitcoin is a decentralized asset. It's not a currency, it's a decentralized asset that offers what they call this value, this intrinsic value, based on the limited amount of Bitcoins that can be produced, which I believe are about 21 million. And the argument is that it will replace the gold market. Gold has been around for thousands of years, for thousands of years. And I'm not sure that Bitcoin has yet gone through that process, that filtering process, you might say, through civilization, that whenever fiat currency collapses, gold and silver, God's money, will save the moment. I've been talking quite a bit here fundamentally on this session here because the markets are pretty quiet, but there are things that have been on my mind here that I wanted to share with you that I believe will bring the light back to the precious metals. When all is said and done, people will realize that they got to have some gold and silver. They can't just have all of it in Bitcoin or just on fiat currency. And whenever we see these corrections here, personally, I make a point of going out and buying some more physical. I'm accumulating physical silver. Whenever corrections occur, I go out and purchase physical silver on a steady basis, regardless of where the price is, until, you can be comfortable with the amount or percentage, you might say, that you can put into your net worth. And, my appetite for the metals may be a little bit different in terms of risk than most people. So, I tend to be a little more aggressive in increasing my share, you might say, of metals in my portfolio. And, I'm in excess of 50%. And the more that this market continues to offer the opportunity here, I will continue to add to my stash, so to speak, because, again, when it all comes down into the monetary system, Bitcoin is not yet ready to be used as a backup, so to speak, for to become a currency or to become some kind of a mainstream exchange, which is becoming more and more. I mean, I'm looking at the velocity of things that are occurring, and it's incredibly amazing to see how fast that technology is increasing. Within its own, ecosystem, they're creating just all sorts of wallets and the ability to move and pretty much trade with a lot of liquidity and basically no fees, no central bank involved. So it is still in its early stages. It's being regulated now, and the regulations have yet to qualify what they are, whether they are a digital asset or, a security, and that's going to determine pretty much registration requirements and so on, which is in the process of taking place. So that world is going through what I believe is a positive thing, because once they're able to settle these markets and to regulate these markets here, they're going to become more settled. The volume is going to be more, substantiated, you might say, with regards to the volatility, and it's going to find some kind of a more lower level of volatility to be able to trade. And so a lot of things are going on, and we'll see what today Chairman Powell will bring. But in the meantime, if we do see a correction back down into that buy one level of 1761 and maybe even 1748, I believe those are the levels that could be providing tremendous buying opportunity here. If not, and we get a bullish indication, we're looking at the market getting up to that weekly level of 1794 all the way up to 1835. Thank you again for the opportunity to share this intelligence with you, and let's see what happens today. In the meantime, my friends, you continue to be well. Take care of yourself, and I'll talk to you soon.